Okay, good afternoon, everyone. You're welcome to today's workshop. As you know, our topic for today is valuations and the size of your round. So let's dive in. So in today's workshop, we're going to be having a question and answer session, a voting and poll session, and a session where we discuss the Founders Toolkit that we created for you, our valued clients and attendees of this workshop. So what we'll be learning today, during the first session, we'll be learning how to create evaluation. And during the second session, we'll be learning about the sizing of future rounds. So still on the agenda, we'll be talking about how to build our startup valuation, how we can determine the size of our rounds. Obviously, we'll be going into a question and answer session, and we'll then dive into a demo of the Raise platform. Yes. And just to begin, I'm going to introduce myself. My name is Ozzy. I'm the B2C lead at Raise, and I'll be taking you through the very first session of our workshop today, which is valuations. So let's get started. I'll start by describing valuation. What is a valuation? A valuation is basically a calculation or a method used to determine the worth of your startup using standard techniques and basic methods that have been used over time to arrive at a specific number or value for a startup. Now, over time, it's been known that early stage startups have very little value or little to no value at the beginning of their startup journey. And as time goes by, they're able to achieve more milestones, the value of their company goes up. Now, in order for founders to be able to reward investors in their company, they usually exchange a percentage of their company, a percentage of ownership in their company for cash. So for instance, if a company is trying to raise a fixed figure amount of about $250,000, they will in exchange sell a percentage of their company to an investor. Now, this is common practice, and if you're looking to raise funds, it is a method that most founders use. And this percentage of ownership of the company that the founder rewards the investor with is usually determined by the amount raised from the investors and the valuation of the company. Just to rephrase this again, basically, what this means is that the amount that the founder gives the investor in exchange for cash is usually determined by one, the value of the company, and two, the amount of cash that the investor is investing in the company. This then brings us into the major part of our discussion of valuations, right? So by this description and by this foundation, it's clear that it is important to know the value of your startup because it is a tool that you can use to determine the sale or the percentage you reward your investors with for your company, right? So in determining to determine a data-driven valuation for your company, there are major factors that you need that are essential and you need to have in order to arrive at this accurate figure or accurate determination for your valuation. And they are a historical and future financial performance of your company, your customer metrics, your team traction and fundraising history, and lastly, the total addressable market. Now, what do these four key things mean? I'll start with the first. So for your historical financial performance, this is basically the past history of your company's financial performance. So take, for instance, your company was established in the year 2017 and you've been functional for the past, obviously, that's about 4 years. If you were to determine a valuation report for your company, you would need to provide your historical financial performance for the past 4 years that you've been existent, right? So that is the historical financial performance. Now, regarding you also need to provide your current standing, right? So in the current year that you're in, like what has your performance been like? You need to provide information about that. And for your future financial performance, you'd also need to provide your performance or where you see your company's financial performance being in the next 3 to 5 years. Basically your financial projection. Having these key records is very important. Now, the next thing being your customer metrics, right? So this basically refers to the amount of customers that you already have existing in your company. So if you're, let's say you're a SaaS company, like how many active users do you have on your platform? How many out of the signed up clients that you have on your platform, how many of those clients are actually using the platform, and what is their projection, their activity within the platform like? So these are the types of information you need to have regarding your customer metrics. And lastly, next we move to your team traction and fundraising history. So for team, as the name describes, is who are the members of your team? What is the caliber of team you have? How much experience do they have? How committed are they to the work that is required to be done for the growth of the company? Lastly, the traction, right? So you were established in 2017. How much traction have you built over time? How much progress have you made? And details around that. What kind of methods are you applying to get details on your traction? Are you doing any kind of analysis on the tools you use? All the details around this, you need to provide information. And again, emphasizing on the fact that these four metrics are data, provide enough data for you to determine your valuation. And lastly, we move to your fundraising history and total addressable markets. So for your fundraising history, this basically refers to whether or not you fundraised before, and even when you fundraise, what did you use your fundraising, the amount you raised for? What did you assign them for? What method did you use to reward your investors? All the information around this, they're essential for determining your valuation. And lastly, your total addressable market. So for the industry you belong to, what's the industry like? What is the market segment? What are the details around the metrics and the figures around for competitors in your industry, competitors in that sector? What is the unique value proposition you have for your company? How does it compare to other companies still within your sector? So you need to analyze all these factors, have them in detail regarding your total addressable market. And of course, the other parts I shared. So still moving forward, it's important for us to also note that now valuations are a health check for your startup, right? This basically means that you do not need to do a valuation report only when you're fundraising. You can do a evaluation even before you fundraise. So if you're not ready to fundraise, if you've fundraised previously, but you'd like to know what your company's performance is like currently, what is your financial standing, what is your performance in the market and your competitive performance, you can do evaluation for your company. It actually has a lot of advantages attached to it, right? So the first is it enables you to control your risk, right? This is because you will be able to control the risk factors of your startup, right? So not necessarily about the value of your company, but it's more about the value you're able to create while you are fundraising. So in this aspect, it's more focused on fundraising and not necessarily about the worth of the company in general, right? That's for the first point. For the second point, it helps you have clarity when you're raising money, right? So for instance, you're in conversation with your investor and you're trying to close on a specific amount to raise, and your investors are maybe a bit hesitant on closing on that particular figure. If you have a valuation, it's easier for you to say, listen, my company is worth a certain amount, and because of the worth, I'm certain that this certain amount is going to give you more value for the company, and you're able to close your round, close on that conversation, or close an agreement on that commitment from the investor. Another point is creating accountability, right? So if your company is worth, say, $1 million in the year 2021, in the next 2, 3 years, you either want your company to be worth way more or to still be worth about the same amount. You do not want to be worth less than what you were worth before. So that sort of gives you a sense of accountability. It helps you to prepare yourself to be able to match up in the next coming years, to be able to level up, to be able to reach your goals, and chart the course for your future, which is the next point. Now, in charting the course for your future, there's a common thing we all know is you can't necessarily know. It's difficult to know where you're going when you do not currently know where you are, right? So if you're at the current place and there isn't clarity around where you're standing, it's difficult for you to make a projection of where you're headed. So in order to chart the course of the future, you need to have the future of your company, you need to have a valuation report. Now moving to the next point, we have the methods used for determining data-driven reports. So there are 5 different methods, but 3 different classifications, right? So for these 5 different methods, we have the scorecard method and the checklist method, which fall under the qualitative classification. And then we have the discounted cash flow long-term growth and discounted cash flow multiple growth, which fall under the future cash flow classification. And lastly, we have the venture capital method, which falls under the exit multiples, right? So diving into the first method, we have the scorecard method. Now, basically the scorecard method is just the determination of the average pre-money valuation of similar companies in the industry, right? So take for instance, you are a fintech company. If the platform you're using to derive your data-driven report, for them to arrive at this figure and applying the scorecard method, there are certain criteria that you need to measure up against. We have the strength of the team, the size of the opportunity, and the competitive environment for which the startup exists, the partnership, customer success and product services, and funding required, right? So basically the way this method works is points are awarded against these criteria, right? So if the team is very strong, on a scale of 1 to 10, you can give the team a certain score, assign a certain score, say the same goes for the size of the opportunity and competitive environment. Points are awarded for each criteria, and at the end of the day, total figure is awarded for that. That's using the scorecard method. Still within the classification, the first classification, we have the checklist method. Now, the checklist method is a lot similar to the scorecard method. Only difference is this time, after awarding points for each criteria, those points are calculated against a sample case score, which is a sample case score for the industry, and then a maximum valuation. So that's a fixed number still within the industry, right? So all the at the end of the day, all 3 figures are calculated to arrive at total value against one criteria. And to get the pre-money valuation, you sum all the total value of all 5 points appointed to each criteria, and that gives you the total score for the pre-money valuation. So with the checklist method, it's basically a collection of intangible assets, right, for the startup foundation, and in projection of the future success of the company. This then brings us to the methods of future cash flows. So with future cash flows, we have cash flows with long-term growth and cash flows with multiples on revenue. Now, with cash flows with long-term growth, it basically means that the startup will survive and grow at a steady and constant rate. And there's a standard formula used to calculate this. The same also goes for the cash flows with multiples on revenue. It means that the startup will survive and grow at a steady and constant rate, but it also has a different formula used to calculate the figure. So if you'd like to have more information around the methods used, please reach out to us and we'll be happy to provide you with more information around that. This then brings me to the investor returns, which is the venture capital method. Now, this method is basically a quicker approach to the valuation of companies. It basically estimates the exit value of a company at the end of their forecast horizon. It's a lot less complicated than the previous methods I described. And yeah, so this basically brings me to the end of describing the different methods used for arriving at a, a clear figure for a data-driven valuation report. Now, in building your own valuation arrays, I'm happy to let you know that you can do that on the Raise platform. And obviously, you would need to come on board to the company, basically creating an account. Once you're done creating an account, you can request the valuation through the platform's dashboard, right? Once you do that, we're able to crunch all the data for you. Obviously, after you've been able to provide us with information about your company, we crunch all the data for you and you are able to claim evaluation directly from your dashboard. And that's basically how it works. And I'm happy to have taken you through the entire process of valuations. Thank you.
Welcome everyone to the second part of this workshop. I am Fin Kimuma, and I will be taking you through sizing your round properly. Welcome everyone to the second part of this workshop. I am Fin Kimuma, and I'll be taking you through sizing your round properly. So in this part of the workshop, I will be taking you through two things. The first is the overview of what a round is, and then the second part is factors to take into consideration when planning your round. So let's get into it. What is a round? A round refers to each separate instance where a company is raising capital through selling their ownership. And ways to sell your ownership may be through selling your equity, using fundraising tools such as convertible debt or a safe note. So we know that fundraising is not a one-off instance, but rather it's a recurrent occasion throughout the different stages that a company is going through. This is mainly to sustain the growth. Moving on, we'll look at the key factors to take into account when planning a round. So I highlighted three of them under this, and that is how much money are you looking to raise in the round? Secondly, how to structure the round, and lastly, defining the size of incentive program. So on the first point of how much money you're looking to raise, founders are advised to use a fundraising checklist. And this checklist will help you plan how to account for the monies that you're raising. So there are three key things that I highlighted under this. First is, what is the money for? So what are your intentions of these funds during the stage of fundraising? Are you looking for maybe funds for product improvement, for operations, or to launch your product, or new hires or expansion of your company too? The second part is, what stage will we be entering in this fundraising? Are you going to be, are you a company in the pre-seed, seed, or Series A stage? And I'll get more into these different stages when I move along into the presentation. And lastly, what are the milestones for the next round? What goals are you hoping to reach over a certain period of growth? Are you looking maybe for market expansion? Are you looking to launch your MVP? Are you looking for new partners or product integration? Next, I will touch on structuring your round. And this refers to the different investment terms that you are offering your investors. So the different terms under this would be percentage of the company that you're selling. So this is very key to consider, because you do not want to end up giving a huge percentage of your equity in your company while you are at a very young stage in your company, because this would lead to dilution over your during the growth of your company, and in turn you'll end up having or holding a small percentage of shares in your company, and in turn you do not want to end up losing control or ownership of your company because you gave out so much, a huge stake in your company in the beginning. Secondly is the instruments that you're looking to offer during this fundraising stage. So this is very key and also hinged on what Ozzy mentioned earlier in her presentation on valuations. First thing, you have to consider the amount of valuation that you're giving. You do not want to end up overvaluing or undervaluing your company, because this would lead to a huge disadvantage while you're talking to your potential investors. Remember that your investors have an idea of the range of valuation in different stages of companies, because in their portfolio, they have previously invested in different companies. So you do not want that to end up being working against you while you're having these conversations. Secondly is, if you're looking for strategic investors, maybe these are investors that will not only fund your company during this fundraising stage, but will also invest in your company in the future as it grows. And you want investors who will grow with your company. So you'd end up looking at favorable terms to offer them, such as pro rata rights and most favored nation rights that would allow them to take part in your future rounds. And lastly is the percentage for employee stock options that you're going to set aside during this fundraising stage. So remember when I was talking about the intention of funds, I mentioned that maybe a company would like to hire new talent for a certain period of time. And with this, you have to know how to incentivize your new talent, how you're going to retain your employees. And by you setting aside ESOPs for them, it works as a great way to offer oh, to offer or to offer your employees in return for their value. So moving on, I mentioned that I will touch on the different funding stages of a company. So this is a simple demonstration of the number of sales, stroke marketing, against the fundraising stages in a company. So first off, I will start with the Precede stage. So at this stage, we know that you're getting your operations off the ground. This is also known as the bootstrapping stage, whereby you're using your existing resources to scale up or to scale into the market. So most companies at their pre-seed stage either need funds to scale up their operations or to launch their MVP into the market to test out the market. So that is why, as you can see, the trajectory of of the sales in the company is very low, because you're introducing your product at this point, the introduction stage. And a good example of this, I will use Fingo Africa. And Fingo is yes, and Fingo Africa is a is a startup that is building a new bank for the youth and Africans. Continue. So here is a quick demonstration of the number of sales and market growth against the fundraising stages in a company. So I will start on the Precede stage. And under the Precede, this is where, AKA the bootstrapping stage, this is where you're getting your operations off the ground. And at this point, you're using your existing resources to scale up. So at the introduction stage, still at the Precede, you're introducing your product into the market. Your product still hasn't yet gained traction in the market, and the number of sales are still low, and they're still getting their trajectory in the market that you're introducing it to. So here I will use a good example of Fingo Africa, which is a startup that is building a new bank for Africa's youth. For Fingo Africa, they were looking to fundraise recently, their Precede, and they were able to do so and gather a total of 100,000 on the Raise platform. They were able to close their fundraising round within 2 weeks. So moving on to the second stage, this is the seed round, where remember that the pre-seed capital, you used it to get your company to full scale. You introduced your MVP to the market. And at this point, maybe some companies have reached their product market fit. And as you can see, there is steady growth in the market at this growth stage. So here, companies are looking to gain traction in the market, also to scale their numbers of sales in the market. And some here are looking to fund their product launch, maybe get important hires that are required in their company. So MVX is a good example of a company that is currently in their seed stage. So they launched back in 2019 as a freight forwarding service company and they did their seed round back in 2019. In 2020, they opted to pivot away from their initial idea and get into financial services and trade in Africa. So they did their seed round last year in 2020, and this was for them to scale their operations for new hires and improve their technology. They were able to get a total funding of 1.3 million USD. On to the Series A to E stage of a company. So Series A to E, this is a venture capital financing stages. And here is where you can see from the graph that I have that there's a steady growth in sales. As you can see, your product has reached its maturity in the market, and now you have constant revenue flow, and a customer base. So at this point, you can either continue an upward trajectory, or it can reach to a point where your sales are declining slowly. So at this stage, I will use a good example of Flutterwave. Flutterwave, which is a Nigerian company that is building customizable payment application through its API. And they recently closed their Series C round in 2021, raising a total of 35 million and bringing their valuation to 1 billion USD. So at this point of maturity, you either have a decline in sales or an increase in sales. And that is because, for example, Flutterwave, they were raising their money for them to scale across different markets and also to continue meeting their consumer or customer demand. So I will move on to the IPO stage. And at this stage, this is where companies are offering their shares to the public. So a good example of an IPO that continued its upward trajectory, I will use Safaricom. Safaricom was founded in 1993. They started off as a subsidiary in Kenya, and they were able to launch their IPO back in 2008. And as you can see, Safaricom's trajectory in the market has been moving up. This is because they were able to scale they were able to scale across different markets and also continue meeting their consumer demand. And this is by them offering different kinds of products as they go. So a good example of this is that after their IPO, they were able to acquire the M-Pesa services and M-Pesa products that are being launched over and over again over the years. And also they are able to they were able to partner with financial services across Kenya and in other jurisdictions. And recently, they've even tapped into the crypto market. So this is through the feature of the P2P trading, whereby you can trade your USDT to Kenya shillings and in turn be sent to your M-Pesa. So an example of a market that is declining or products that are being slowly deleted from the market is a typewriter. So when the typewriter was invented, of course, its sales flew the roof. I mean, its sales in the market were off the roof. But then in turn, due to the introduction of computers, laptops, iPads, and the phones that we use, it got slowly deleted from the market. And these days, no one or very few people use typewriters. So that comes to the end of the demonstration. And let's look at an example of the number of deal rooms we have on the Raise platform. So currently we have 38 live deal rooms, which total to valuations which are done. So let's look at an example. We currently have 38 live deal rooms on the Raise platform, and we've done total valuations of over 100 million USD. And I believe that this could be higher because who knows, your deal room might be next on the platform. Thank you so much, and back to you, Rushab. Yeah. So let's look at an example. Currently, we have 38 live deals on the Raise platform, which total to, sorry, let me start again. So let's look at an example. We currently have 38 live deal rooms, and the total deal value of each of all these companies comes up to more than 100 million USD. And I believe that after this, you could be one of them. Thank you so much. And back to you, Rushab.
All right, so I believe that should answer your question, Wale, unless you have more to say.
No, that's very clear. Thank you.
All right, great. We've got another question that Marvin has tagged that he's going to answer it live. I think it's a good follow-on from exactly what we're saying. The question from an anonymous attendee is, for seed stage, I believe revenue and traction also have an impact on how much one can raise. What are the multiples we can use to estimate the amount being raised vis-a-vis revenue one is generating, e.g. raising 5x revenue or 3x revenue, so on. Marvin, you want to continue with that as well?
Yeah, definitely. And anyone from the team, as we was doing just now, chime in, let's have a conversation about it. And I guess this person, hi, anonymous attendee, we would unmute you if you knew who you were, but thanks for your good question. So Here, when we talking about, Ozichi was talking earlier about the different kinds of valuations, right? Let me just go to here, but she's talking about future cash flows, discounted cash flows, checklist methods, scorecards, qualitative and quantitative ways of looking at different companies. And a lot of that data is always going to apply when you do an evaluations, but you can imagine as companies get complex over time, they have different business units, different lines. Over time, it becomes just easier to create a shorthand version of the valuation. And one of the easiest ways of doing that is just looking at the revenue, looking at the stage of the company, and multiplying the revenue to create a certain valuation for the company. That's not the only thing you're doing. Behind that, there's like standards, there's agreed upon industry data that you're using to value that kind of industry business that way. So as an example, these are just hypothetical examples. There's no numbers attached to it. But we've seen, for example, two companies, company A and company B. Company A is a SaaS-based fintech product. Let's just call it that, right? And company B is a B2C company that sells stocks, like helps companies sell stock, an example. Or like Bundle as an example in Nigeria is company B. Company B is probably going to have a higher multiple on their revenue because they can scale faster because there's faster distribution as B2C is direct to people. So people will say, yo, I'll give this company B 100x on their revenue. That's the valuation. So if the company is making $100 and I put 100x on it, I think that's $10,000. That's the valuation of the company. So you just 100x it. A SaaS company, by virtue of that business model for company A and how it works, it grows more slowly over time and the distribution and the sales cycles are longer. So instead of saying that's 100x on that SaaS company, you could say, well, this is a 30x on the revenue of this company at Series A or a 10x at the valuation at the pre-seed seed level. So revenue attraction are more than enough, you're right, to be able to justify a valuation. And then using these multiples, but also backed by actual data, you can't just throw out multiples. Helps create like a very easy way to understand. So it's like, yo, like to Wally's question earlier, and his concern was, how do you get to the next stage? If you know that the industry of your company is like company B and you know there's 100x potential valuation you can justify in revenue because of the industry and product you have, then you know how much revenue you need to make to get to 100x. You see what I'm saying? Anonymous attendee. So I hope that answers your question. So you get a better sense as well on raising X multiples on revenue.
All right, yeah, thanks for that. I see Efe has had his hand up for quite a while. Apologies for the delay. Efe, I'm gonna give you a chance to ask your question. Yeah, feel free to unmute yourself and ask your question. Feel free to direct it to any of us if you want, or just ask it openly. We'll jump in with an answer.
All right. Hello. I have this company. I'm just joining the call. Sorry, I was driving earlier. I have this company. We've been working on it for a while now, right? And right now we've gotten, you know, the necessary things on ground. All we are headed towards right now is publicity, basically. It's a tech company that has to do with providing hair solution. It works exactly like the Ubers and the rest of it. So this time around, you order for hairstylist and they come over to your space, you know, both male or female, whichever way it is, and then you get your hair done. And also inside the app, we have sales of hair products as you buy your hair products in the app, and then there's a hair clinic that helps people get their hair or wigs, you know, treated and all that. Now the app is developed. It's already in the Play Store, the Google Play Store and the Apple Store. And then in Lagos, Nigeria, we have over 800 stylists registered already. And we shot some TV adverts already, and we've been working basically, but right now we want to push strong into the market. We developed some kind of structure on getting downloads, not just download, active users, you know, through physical activations, online activations, and other outdoor mediums like that. So my question is, having done all of these, how then do Raise as an entity, how do we engage Raise, and how do they help us in raising the funds we need to push ourselves to the next phase? Hello.
Yeah. We heard you. Have you created a valuation already? And have you
Yeah,
started fundraising already?
we've not started fundraising. All right. I just got into your platform like day before yesterday or so. I just heard of it through the social media network. So I registered up for this meeting, and I really don't know the process it takes to get fundraising. I just said, let me give it a try.
First step, let's look at the 3 steps. First step is understand what you're fundraising for. That's the first thing. It sounds like you've been working on this a while, so you could communicate that in 2 pages of writing, right?
Yeah.
Because at this stage, sound like where you is, a lot of it is going to be communication of where you're trying to go and where you aim to go. You understand? That's the first step, is being able to communicate that in a page, the market, the business, the model. Don't even think about a pitch deck right now. Just write out a 2-page document like that. Next step from there is to try and put it into some kind of like visual format. Right now, don't think too much about like cap table and equity and valuations, all that stuff. You need to first understand as well what you're going to do, like why you're fundraising. The tools after that are just tools. So start there. That's the first place to start. And then from there, there's tons of resources to Raise, through online. Now starting to have conversations with people who also looking for companies to invest in. You understand? And then you start to have those conversations. See, like if we was raising this much money at this much valuation for this kind of company, what would you be willing to invest? And then you start to have that conversation and you start to understand what to say and what not to say and how to communicate where you're going. So start with that 2-page document.
Yeah, we have that. We have the document, and I have a video to that effect also.
Perfect, yo. Go use those 2 things and start having a conversation with investors. Ozichi should be answering some questions. She's you heard from her, she's on the team. But connecting startups with investors, there's a couple of resources online that we usually share. And then that's the next place for you to go now. Now that you have a sense of where you're going, what you're building, now speak with people. Never lose sight of your customers. If you're running a company and it's early and you're still trying to get things going, be sure that you are allocating time really responsibly throughout the week, over multiple weeks, to have these conversations and focus on this, because it will take away time from building things that your customers want you to build. You understand?
Yeah.
So you have to allocate your time really responsibly if you're going to start doing it. And no one really going to start investing like aggressively for the next month, because things start to slow down when you look at data in our ecosystem. So think of it as I preparing for January to do this thing, to go out and raise this round.
Okay.
That's some helpful action steps for you, yo.
Okay. Okay. So lastly, I think where do I tend to post these 2-page document and the video?
So 2-page document and the video. First thing is, in that 2-page document, there's 3 essential things you need to be able to write out. This is something that you'll be able to use, as well as it helps you understand. So for now, you don't need to post them anyway. You just need to send them to people that you're having conversations with. Anybody who's listening on this call, if you have a pitch deck and you feel like that might not be working, and you have an investment memo, which is a 2-page document that you write, also try that out with investors. So when you're having these conversations, send around these materials to people directly through email, through WhatsApp, things like that, people that you trust to send this to, right? And that's where you start. Don't post this publicly or anything like that unless you crowdfunding from everybody, because then you're exposing all the information. And we're not sure if that's something you should be doing yet.
Yeah.
See what I'm saying, Ife?
All right.
Yeah, but first you need to understand what you're doing. And that's, if you already have that, that's dope. Next step is to start to get and see how other people feel about it who are willing to invest, and share it with them directly and get their feedback. There's an app called DocSend. If you have a pitch deck,
Yeah, I
I
have a
posted it.
picture.
Use DocSend if you want to be able to track like per page what your investors looking at and conversations you having. It shows you what people are interested in, and then you could build a better pitch deck out of it.
Okay. Okay. Thank you.
All right, thanks for that, Efe. I see you had a few questions in the Q&A section as well. I hope that's sort of been covered. I think we'll move on to Joyce, who's had her hand up as well. What I'll say before moving on to Joyce is that obviously we're having a lot of questions coming in. So what we've started doing is answering the questions directly in the Q&A section because we don't want to overrun this entire conversation. If you'd like to ask your question live, please raise your hand. We'll take it live. In the meantime, we'll continue answering the questions directly in the Q&A box. So just letting you know about that. That's how we'll continue from now, just so that we manage time more effectively. Right. I will move over to Joyce. Joyce, you can unmute yourself. Please go ahead and ask us what you'd like to.
Great, thank you so much. This is very useful, guys. So thanks as well for organizing the session. My name is Joyce Mbaya. I'm the founder and CEO of ZD. We're B2B SaaS, offering a platform where businesses can upskill employees using virtual training. So LinkedIn learning, but tailored for the African audience. I'm the one who asked the question about the revenue versus traction. And the reason is because, so let me give a very practical example. So you're raising, let's say 200K, right? And you've determined this amount based on what you feel your business needs, etc., the checklist, correct? But then in the process, an investor says, oh, you know, what's your revenue? Maybe you say your revenue is, I don't know, 20K. I'm just giving hypotheticals here. And then it's not about the amount you're raising. It's more like, oh, but based on the revenue you have now, it's too early. You need to work a bit more on your product market fit. You need to improve on your commercials, improve on your revenue. And then, so this investor is a seed stage investor. They are in a position to invest their money. So your investor fit is correct. They're a seed stage investor. 200K is right up the alley in terms of ticket size of what they can invest, you know. So they are the right person, but they're looking at you and saying, we still think you need to be generating more revenue, I guess, you know, or doing better before you can have these conversations. Work on your sales a bit more. So that's what I meant in terms of how there seems to be this underlying, I don't know what to call it, you know, there seems to be something about where your revenue is at versus what you're raising. And that's why I was asking. So for this person who's at 20K, should they have been raising 5x revenue, which is 100K, instead of raising 200 or 250? That was really my question. So it's how there seems to be a subjective perception about your revenue vis-a-vis the amount you're raising, and this is not necessarily tied to your valuation. I hope that helps, but that was my question, you know.
Right, anyone want to jump in with that? Gina, Fane?
Yeah, thank you. So thanks for that question. So you said, remind me again, a B2C SaaS company. Tell us a bit more about like the industry again.
Oh, no, for me, it's B2B SaaS. It's HR tech, but also ed tech, because we're offering training. But then my business model is subscription-based, per employee per year, right? Like I compared it to maybe what LinkedIn Learning is doing. That would be an easy way for you, I guess, to understand it.
Like per seat. I see what you're saying. Yeah, that's probably why, right? Like, it's weird because a lot of this has come back to like people's subjectivity, like you hinting at, right? It's like some people will be like, you don't have enough revenue, and other people will be like, you have enough for now. You see what I'm saying? And like, especially when it's like per seat B2B SaaS for a product that's still unproven in this market, you're probably going to continue getting that from people, right? At the same time, understand that like at this stage, it's like a pre-seed stage company, right? I assume your
So I've
company.
actually raised before. So I've already raised a pre-seed. Now I'm raising my seed. So this is my second round.
Yeah, at the seed, it becomes a little like I imagine your pre-seed deck was like, yo, this is the traction, this is what we're building. Whereas now is more like, here's our existing traction and numbers, right? Yeah, for that, like Tina was on the call and able to chime in as well. One of the things she did when we were fundraising, we had a similar situation to you, was like really focus on the user metrics, like the customer metrics, you know what I mean? Because at this stage for you and most companies, like it's more important to prove that you have an incredible customer success, customer service going on. You see what I mean? And like the data of where that could go and how you monetize it. So the way to think about a lot of these milestones is pre-seed is like, where you coming up with an idea that you think makes sense and you started building it, you have some initial traction. The seed round is where it's like, all right, cool, this thing got some traction. Now we basically have to prove a repeatable business model because now you're about to build a company, right?
Yeah.
So when you communicate with people, it's just like, yo, our revenue ain't there yet, but that's not the point of this seed round. The point of the seed round is for us to build a repeatable business model. Let me show you and walk you through the business model that this seed round is basically funded to do, which is per seat. Like that makes a lot of sense. It grows more slowly, but it makes a lot of sense because if it grows per seat, per employee, and a B2B SaaS product, you actually a really strong post-EBITDA company over time. You see what I'm saying? And anybody who telling you have not enough revenue, most times, like you're not investing in startups at the seed stage because they're making all the money in the world. You understand what I mean?
It's
like,
a potential. No, but when you've said customer metrics,
yeah.
I get it. I think we have some data. Actually, you've actually answered my question now. So it would be about prove the customers love your product, prove they'll keep coming back, prove they'll renew their subscriptions, right? That's what you're saying. So show that even though the revenue is not in the hundreds of thousands, we already have a working thing. Now we're trying to scale it, you know?
Yeah, exactly.
Yeah. So you've answered my question when you said customer metrics, because I think we're showing historical financials and talking about ARR and stuff like that. But then, yeah, I don't know if I actually don't think my decks even have our customer metrics, cost rating, learner engagement, that sort of data about how our customers engage with our product. So that's a good tip. Thank you.
Yeah, use both. Don't think like you use one exclusively to that out. Use both. Use the customer metrics to explain like how you building a model, like a thing that basically think of as use like building this thing that now you're gonna fit a monetization into. You understand? And then show the monetization metrics is like this is like the traction we've had, and this is where we're going with it, and this is the valuation based on that. Is more like show it as customers love it. We're already making some money. This is how we think we're going to continue making more money. So when you paint it that way, it is a lot harder for anybody to be like, but you don't have enough revenue. Then it just kind of looks silly if someone's saying that. And then you are in control of your valuation now because you know where you're going.
To add on what Marvin said, Tina here, it's great to show the your data of your customer metrics, but also showing the potential of the market, like how big is the total addressable market and how much percentage of that market are you planning to acquire. So it's showing that basically like here is where you are today with your existing customers and how you're planning, and this is how big the market is and how you're planning to acquire that market. So some investors might go into granular, like asking questions of, okay, so give me like a typical way of how you do your sales process. And that's how they're trying to see and gauge how the potential for you to scale.
Okay, thanks.
All right, thanks for those very insightful questions and answers. Joyce, thank you very much. Right, I think we'll move on to Kinshuk, who's next up. Nick, I believe you had your hand up. I'm not sure if you dropped it by mistake or if your question was answered through everything we've been talking about. So yeah, I see your hand's gone up again. So I think we'll get to Kinshuk first, and then we'll come to you, Nick. I see Neil Ribeiro has a couple of questions, so we'll get to him after that. I hope that's in order. Right, Kinshuk, yeah, please go ahead, unmute yourself, ask us what you need to. Kinshuk, I believe you're muted. Maybe you can unmute yourself.
Yeah.
Yeah.
Can you hear me now?
Yeah, perfectly.
Okay. So, okay. So I will directly jump into the question directly. So currently, I have a company which I've started already, which is, you can say, I have done the preceding or bootstrapping by myself. And we have some revenues as well. We have revenues, we have customer base and all everything. Now we are looking forward for the seed round, or you can say we need an investors to come on board. So my only question, what I was thinking is that what are the exit options we can provide to the investors, one part, because in Nigerian landscapes, the IPO is not very famous for now. Okay, so because as Samantha, I've seen her answer, she mentioned that strategic acquisitions of the founders may opt to the family-owned companies. These are the two options. But this options of acquisition, other than acquisition, what do we have in our hand in Nigerian landscape? One thing. Secondly, is if a company which is working in Nigeria, or you can say the Western Africa, can they list themselves in some other part of the world? Will they be accepted, or is there some other preconceived opinion or something else?
All right, well, let me, I guess, touch on that, and then maybe we can hear a little bit more from the other panelists. So I'll give you a couple of examples which I feel are relevant to Kenya, and depending on your business, of course, they might be more or less relevant. So one thing is actually, I think the answer that we ignore quite often is that sometimes you don't really have your typical VC style institutional investors. Sometimes we do have investors who are just interested in future cash flow. And that you often see that with family businesses, with smaller businesses, but it's still something quite valid as you grow. Meaning that you have your early stage investors who are not necessarily looking for an exit, but they're just happy with the incoming cash flow, dividends, and so on. So that is an option to explore, obviously a lot less popular, but I just want to mention it so it's something that you can consider. The second thing I could probably say about that is, yes, you can list an African company on a different stock exchange. I believe, and correct me if I'm wrong, I believe Jumia, obviously African company, but it's listed on the New York Stock Exchange. So that is very much possible if you want to avoid the African exchange market. And obviously you talked about strategic takeovers as well. So I guess that's my 2 cents on that. Anyone else care to add to what I just said?
Yeah, I can throw it. Nice to meet you, and thanks for your question. Yeah, a couple of
Marvin, would you mind speaking up just a touch? I think it's
sorry. This better now?
Super clear for everyone. Yeah.
Rashad, Kinshuk, you can hear me?
Yeah, I can hear you.
Yeah, so the traditional ways is what you were saying, right? Merger and an IPO and those things, right? But they're not like, the merger is more likely than an IPO anytime soon. I think you said Nigerian Stock Exchange, not yet. I think anytime soon. I think it's going to take a while, right? So realistically, what's happening now is you have this ecosystem, the startup ecosystem, and I'll put up my screen so you can see it. What we have right now is a lot of companies, like a lot of us are issuing safes, right? I don't know, did you raise with safes? Should I ask you that?
Sorry?
Kinshuk, when you raised your money, did you use safe notes or you issued equity directly?
Say equity.
You issued equity?
Yeah.
Okay, so when you raise again, so one liquidity option is when you raise again, because you mentioned that you gear up for your seed round. Let's say your seed round now is going to be, you raise in $2 million and you're saying that the valuation of your company is $10 million, right? But previously, when you did the equity round for your previous investors,
Yeah.
they did it at a $5 million valuation, right? So
yes.
your valuation.
Yeah. You can take
Just
it
like-
hypothetically. That is not the value. Means, yeah, you can assume that value.
Yeah, this is totally, I want to be clear, it's a totally hypothetical example, no real number whatsoever. Thank you for clarifying. So, right, so at the time when you raise that $2 million, this goes for anybody, including Kinshuk, when you raise that $2 million and you say, yo, you go to seed round, and then actually there's like people who like, yo, I think I'll invest another 500,000. So you actually end up raising $2.5 million, right? That extra 500K, you can basically use for people to buy equity from the earlier investors. That is what you call a secondary. So that is becoming much more common across the space, probably will continue to, probably needs to. And the reason it needs to, in your case, it's a bit more straightforward because you did equity. You should be able to see my screen. In most our situations, the most ecosystem, when you look at this slide right here, you see that 70% of the ecosystem is like pre-seed, like seed stage. A lot of us end up relying on safes. So similarly to the example about this realistic exit option for your investors, there's also safes. If you issue a safe at a valuation cap of $5 million, then you issue a safe at a valuation cap of $10 million in the future, same principle. You can sell off the newer safes for people to buy the earlier safes to get liquidity for investors. So it used to be the case that people was waiting for equity to get to a certain amount, like in your example, and then they would sell off at the IPO or merger and acquisition, but that's so far away. These secondaries, like your next seed round is probably next year. That is an option for liquidity. Your round after that, your Series A, is also an option for liquidity back to these investors as an exit option. So the most viable way of creating liquidity in the shorter term is this function, which is called secondaries. But they usually reserve for more stable revenue generating companies because it's risky. If you start reselling a bunch of things on your cap table every time you raise money, you also create a lot of activity on the cap table that could be risky, right? A bunch of people entering your cap table, you might not even know over time. So you have to use it very carefully. For your seed round, like when you come up with the calculations for this is how much we raise in this valuation, stuff like that, feel free to reach out to us on Intercom when you get to that point and just have that conversation. And I'd be happy to follow up with you, where you can even start to calculate, all right, if my valuation was X, I can offer these two investors this amount of money to sell the equity to the new investors. You can calculate that.
Okay. Fine. Basically, can you hear me?
Yeah, we can hear you.
Okay, yeah, so that chart is fine. Basically, I just have because the confusion is coming from where it's a company which I will say that it's a consumer company, means consumer products company. It's not a tech-based company much. So generally, the problem is with, likewise, Rishabh also mentioned that there are some companies which can be listed on the New York Exchange and all everything, but most of the companies are tech-based companies, so which can work anywhere. But in case of a consumer-based company, if you are selling a product in an African continent, then probability of getting listed into the first world countries or any other country might be a difficulty, which I found, because there is no certainty over there for the investors to invest in that. So am I right in this viewpoint, or am I wrong? Means according to me, consumer company which is operating in Africa is not going to get a much traction in the other countries in the stock market. Am I right or wrong?
I think you might be right. I think that, like, and this is totally hypothetical and opinionated now, it's a very good question, is like, at some point we have to figure out a liquidity mechanism that involves a stock exchange. So like Rishabh was saying about Jumia and all these different companies, Chipper Cash probably on that direction right now, Flutterwave too, they have to list somewhere. And I've been seeing the London Stock Exchange do a lot of events in our ecosystem lately, so they're probably trying to do this. I know the Kenya Stock Exchange is trying. I've seen rumblings of like New York Stock Exchange. So like at some point, these exchanges could start listing a bunch of assets, and then it don't really matter where it's coming from. You could have your company say, we're going to list 2% on the New York Stock Exchange, but we're going to list 10% in Nairobi because a bunch of people from Kenya and Tanzania and those people invest on those stock exchanges, and they in that region, they're my customers.
Okay.
Okay.
Okay, thanks a lot.
All right, thanks for that, Kinshuk. Very, very insightful.
You want your
question.
customers to own your equity. People that is delivering to who own stock. Yes.
Yeah, sorry about that. Right, yeah. Thanks for that, Kinshuk. Super insightful. Yeah, really good to hear that, and really good insight from Marvin as well. I think we're all learning quite a bit here. I'll move over to Nick first, who's had his hand up for quite a while. Then we'll shift over and answer Neil's questions. Oh, Nick, you've dropped your hand again. Right. So, yeah. All right. So yeah, Nick, I've given you the opportunity to unmute yourself. Please go ahead, ask your questions. After that, we'll move over to answering Neil's questions, which are sitting on the Q&A. I believe Marvin's tagged those as you'll answer those live, and then we'll move over to Ahmed. Yeah. So Nick, you have the floor.
Thanks, Mike. Sorry, my connection's pretty poor, so please ignore the background music if I cut out. I guess I have two questions or two parts. So we officially launched, and I bootstrapped a company here in Kenya. We officially launched in October. We've seen some good traction. We've signed 5 customers. We're probably on track to be break even end of Q2, mid to late Q2 next year based on our current business model. I was of the view that maybe we take a bridge or equity kind of finance deal to get us to that point, and then think about like a true seed raise. But talking with some investors, both kind of angel and then institutionals here, they're of the view that I should just go for a seed now. And so we opened up a seed round kind of tentatively this week. And so we've got commits on the family and friends side and smaller investors here for 250K already. But the institutional investors, those combos will probably start next week and 2 weeks after. Now, my view is we still want to cap it at 2 million to not go too crazy. But my concern is, how do I structure that in a way that there is more favorable terms for the angels and friends and family, and that it doesn't piss off excuse my language, frustrate the bigger institutional investors who are really going to carry me through if I get to a Series A or B or C, if that makes sense.
Yeah. That's
because my concern is they're going to be like, hey, let's see your cap table as part of their DD, and they're going to be like, all right, well, why do these guys who are writing 50 or 100K checks have much more favorable terms? I don't really know how to message that. I didn't plan to do a pre-seed and a seed together. It just kind of came together quite quickly.
Yeah, I got a good sense of where you are. This is Nick from Letta AI.
Correct.
Nice, man. Nice to have you. Yeah, that's an interesting one, even. So, a VC that stresses you out because you gave preferential terms to family and friends is probably not a VC that you want on your cap table. That's the first thing I'll say. So that is a really easy way for you to filter out who you want, because if they express, like asking a question about it and then you justifying it as their family and friends should be enough. If someone poke holes and ask more questions, then you should be concerned. And so that's the first thing, filter out those people. The second thing is, the way you build it in such a way that is advantageous for those people is this. So you can see my screen, right? Now you're doing a 2 million. So you said you want to raise a 2 million cap.
Yeah, 2 million on a post money safe, anywhere between kind of like 7 and 9. Again, I think that's a bit of a negotiation, but I think between 7 and 9 is kind of the sweet spot.
I get you. And you never did a pre-seed at all, right?
No, I bootstrapped it myself. Yeah.
I got you. Yeah. Okay. So here's what you can do. The VCs right now in November, they're not going to fund you before the end of the year. So it's not realistic to even expect that in your strategy. So write that off. They'll probably come in the new year. There's many reasons for that. One, like, is vacation, we all exhausted. 2, like, their capital calls need to happen now. So by the time they do the diligence and all that stuff, they're not going to send you the money before the end of the year. So write them off. You should be focusing on family and friends right now, because they are more likely to invest because the holidays are approaching and time and people have commitments, they want to make investments. So focus on that. The reason that is because if you're going to truncate or distribute your cap table in such a way that you're giving preferential terms to your family and friends, you have to basically stagnate the valuation cap in such a way that it does that. So for example, your family and friends wouldn't be investing at a 9 million valuation cap. You'd want them to invest at a 4 million. You see what I mean? And then by the time the VCs come in, it's like, yo, here's a 10 million, because how could you possibly be price sensitive? Like, you know, like you literally, your job is to get us to 1,000x. If you're complaining to me about a difference between 6 million and valuation cap, then we obviously at odds about how to build this thing. And that's why you get to filter people out. So sell those to the family and friends now using like a lower valuation cap based on the percentage. So here, how it would look like on the raised product, I can show you in a second, but first I'm gonna show this pie chart. So you'd say that for this round, you raise in 2 million, there's 100% of the money, right? There's 4 groups of people you'd want to distribute it across. Family and friends, like you said. Then there's investors, like I guess that's just general, just call them angel investors, right? Those are different from families and friends. And then VCs and syndicate. And then you just decide what percentage you want to issue to each one of these people. So let's say you wanted to do 20% to your family and friends of this round. That means that the allocation of 200,000 is available. Is that 20%? I'm tripping. Is that 400%? No. Excuse me. I'm blanking. Need a calculator. 400,000, there it is. Okay, so they would invest 400,000. So no one else other than that 400,000 is going to buy that piece of that 400,000 at a $4 million valuation cap. You understand what I mean?
Yeah.
And then for angel investors, syndicates, you basically reserve pools of the cap table for the seed round and distribute it to those groups of people accordingly. And family and friends is the easiest first place to start because they give you the easy traction to then say, you know, in new year, we have a slightly higher valuation cap. Now we open it up to angels and VCs and syndicates. Think of it as like an auction. So you plan it out.
Yeah, makes sense. Makes sense. Yeah, I think the way it's working is some of these angels are kind of blended into family and friends just because they've brought me clients and been quite strategic. And I think that allocation is probably like 250, 300K. So I guess what you're saying is do that raise now and then look to plan the bigger raise and valuation cap for the remainder of the next year. That makes sense.
Exactly. Are you confident that your end of year numbers are going to be strong enough to have a strong story for the seed round?
Yeah, I do. I think we've got a lot of work to do, but the pipeline is pretty promising and optimistic. We
always got work to do, my friend. So if that's the case, end your year strong with the metrics that you have, and at this point is all storytelling with the numbers anyway, and in a new year go out to the world with a stronger seed round and use this one to get your family and friends in first. And structure cap table. If you can see my screen, this is the scenarios feature for everybody to see on raise, and in here we had a very similar situation to you, Nick, in our round we just closed, exact similar. And we went through this process of splitting up the cap table this way, and we used a raise platform to do it. And when we did that, we basically were taking the terms. So in this case, it's similar to yours, right? There's not similar to yours at all, actually. There's a 2.5 valuation cap raising 250, so 10% of the company, right? And then we'd use this tool here, the scenario. So you 250, in your case, you're doing 2 million. And you sell out a certain amount of the company. And you can save the scenario and then view it. So for example, the terms, I didn't actually change the terms, excuse me. There you go. So you raise it on a 4 million cap, for example. And that's probably where like somewhere you probably wouldn't family or friends. That's up to you to decide. But in here now with these terms, you can basically update this cap table to see, all right, cool. If I did these terms here for 2 million, then my family and friends that I add to the cap table here, they're going to invest, what would we say, like 200,000 of that using a 4 million cap. Then you add them and then you can see like what their percentage would be. So here, for example, this cap table is like a demo. So there's like crazy stuff on it, like huge stock options. But the principle here, you'd see their percentage would be right here. So you'd be able to back calculate which kind of valuation cap you can give them And then up here, you can do the same thing for syndicates, et cetera, et cetera. So it's similar to this chart we were looking at, using the actual raise product to divide your cap table. And we'd be happy to help. Just chat us in this intercom box down here with the example, and we can give you feedback on it if you need.
Yeah, this is super helpful. Thank you, Marvin.
Glad to hear.
And then just lastly, like to tie out, I do think, and maybe I'm just misreading this, but because the VCs seem quite interested, I'm wondering if I've undervalued, because I imagine this is a lot more of poker, but the interest has been quite positive, and I think maybe that's a function of me maybe having the valuation tax in low. And I think obviously I probably should leverage a tool to get an updated valuation, but I'm wondering if that's also something that I'm not reading between the lines.
Yeah, you have you done a valuation, like a data-driven one?
I've really kind of used the VC method. I haven't really done a fully detailed one to feel confident in it. But I do have external advisors. I have been working with them, and they kind of think the sweet spot is between 7 and 9. It's just a little weird with the VC to like not really talk at that number.
Well, remember think of it as this way: we in a huge technology bull run that's probably going to last a while. These valuations that today we talk about seed round 7 and 9, one day for the same company in the same project in 2 years will probably be a $45 million valuation. Like valuations change over time on the seeds, right? So, so for you, like right now, I wouldn't worry too much about that. Like just sell it where it is, because depending on where you want the company to go and the valuation and the growth that you have in mind, right? The difference between 7 and 9 and 15 is like negligible in the future. When I say negligible, not that the percentage that you're selling is negligible, that's very important. It's more just like, we always have to decide what kind of company we want. If Letter AI is a moonshot, then it doesn't matter. If Letter AI is something that you want to take to be profitable and post a beta, then that's a different set of decisions that you need to make around the cap table now. But ultimately, like more and more, I think for all of us, the less equity we can sell over time and the further we can get towards profitability with the cap table still being owned by our teams, employees, families, and friends, the better. So get a valuation. If you through Raise, we offer that service, and then you can use that data with your external advisors to like actually concretize something, and then use that. And then the VCs they're going to be more of a market discovery. And even if they, the institutions, their job is to do this. You'll go from here's this 7 to 9 valuation to them being like, here's all these rights and preferences we want on that safe too. And either way, you're going to give up something. So if you can get away with a higher valuation because they think it makes sense and they can like diligence that, definitely shoot for that, because then you save your cap table.
Yeah. Makes sense.
I hope that wasn't conflicting advice. I was just trying to give you there's many different ways of building a company. It's up to you.
No, and that makes sense. That's very insightful. I appreciate the feedback. Thank you.
Pleasure, man. Thanks for your question.
All right. Yeah, thanks for that, Nick. Thanks for that, Marvin. Of course, you guys have got a little sneak peek into the Raise platform itself and some of the value it provides. I'm sure a lot of you can take from that. Feel free to contact us. We can speak more about it, show you some more features that could be very, very valuable to you guys. Right, so I am gonna switch over to, I think Neil has had a couple of questions. Again, Marvin, I think you've tagged these as that you'll answer them live. So I'm just gonna I'm just gonna verbalize the questions themselves, and then I'll hand them to Marvin. So Neil is asking, we are post EBITDA looking to raise 5 million to drive growth. It baffles me how pre-revenue companies are able to raise $5 million. What are they doing that I'm not? So that's the first question. The second question from Neil is, our business, sorry, there's a bit of a typo. Our business gets revenue from a subscription model and is growing between 15 and 30% per quarter. There is a 30% gap in what I believe we are valued at and what investors feel our valuation is. They base it on quarter's performance. I base it on next quarter's performance because that is when I will get the money. how do I close this gap? Right, Marvin, over to you. And just FYI, I think we did have a question from an anonymous attendee, which was quite similar to this. So we should be covering that all together. Marvin, over to you.
A pleasure. I'll give it my best shot, Neil. Nice to see you, and I'm from Activate, a nice website. Looks very good. These are good questions. First, to answer like the one about pre-revenue companies raising all this money, you have to understand that the whole world of tech funding right now is on vibes. That's just what it is. You can have the best performing businesses in the world. If it's not on vibes and hype and energized, people are not going to be as energetic about it. So for that, like, understand that you're fighting like an uphill battle. Like, I've seen companies raise money faster than like a stable like yours, like 15 to 20% growing steadily. I've seen people fund companies with no product, way more money. It's nuts. So you're right. Don't get discouraged by that. It's just kind of like the market driven. And then for your growth, so Activate, it seems like it's growing 15 to 30% per quarter in revenue, which means that you are becoming better at operating a company every single quarter, right? So the way to justify that is, I mean, simply like, sure, we could look at last quarter's performance, and that makes a lot of sense. That like obviously is proof of the business model being repeatable and working. But here you build in an Activate. Like, if I remember Activate correctly, and please type if I get this wrong, but you do play in the fintech space, right? And for that, like, you going on future revenues, dude. Like, it's not about not fintech employee work and things like that. And it's kind of similar to business model earlier, the B2B SaaS business. The question was being asked about employees being charged per seat to use a service. You building the business for the future. You're trying to get from 600 outlets being accepted at in Kenya to hundreds of thousands. It makes no sense from that perspective to be basing the valuation only in the last 12 months, instead of basing it on the future 12 months and the future multiple years after that. So I remember you guys are very thorough, so I'm sure you've gone through a valuation process and got one done and stuff like that. So it might be time to refresh it and use that. And it's not about what investors feel your valuations is about what you know your valuation is worth. So in these conversations, in addition to having that data available and like communicating on like the future of the company's growth, also just like you're one of the founders and leaders of the company. It's your job to like defend the financial performance and the financial ability of that company to grow over time. So in those calls, it's not about how you feel. Ask people to be like, all right, cool. You think our valuation is XYZ, then please send me an email showing the calculations by which you use to do that. And then the people who don't send it to you, write off. You don't have time for those. And the second thing is, if people do send it to you, then that's literally just another useful way for you to use their Excel sheets to come up with your data, to understand your company, communicate it better in the future. So we had a situation similarly where someone was like, we feel like evaluation is X. We're like, okay, we talked through the business model for a while, and they're like, I think you can make more money doing this. We're like, cool, dope. You think that business model could work? Send us an Excel sheet. And they did it because they have analysts whose job is to do that. And now we use that Excel sheet. So either way, you're both winning. So that's another way to frame it. Tell people it's not about how you feel. Show me the data that justifies it, because we've done the work. If you want to invest, you also have to do the work. So it's a bit of posturing as well as like providing that data upfront. And if you have a valuation you've already done, which I'm sure you have, time to probably revise it based on the future 15, 20, 30% growth over the next like 2 years. Thanks for waiting for your question. I hope you're still around. I think I saw you just now.
Yes, I am, Marvin. Thank you very much for your response.
A pleasure, Neil. Thanks for coming.
All right, thanks for that, Neil. Anything else, or should we jump over to Ahmed? And I should mention we're running out of time, so I will get Ahmed's question and then we'll answer everything else in the Q&A box. But I think that's the last question we can field live is probably Ahmed's question. Neil, I'm assuming by the fact that you're muted, you have asked what you need to. Ahmed.
Yeah, I'm good. Thanks. We can give someone else a chance now.
Cool. All right. Awesome. Ahmed, handing over to you. Ahmed? Seems like we've lost Ahmed. Right. I guess in that case, that concludes our Q&A session. I think we've got some really good questions from you guys, the audience. We had some really interesting answers. I know personally for me, I've learned quite a bit from this. There was a lot of things that even with my experience in VC, I actually didn't know about. So it's really good to get different perspectives from people in, across the continent with different business models. So yeah, really appreciate that. I believe what we have next is we are once again handing over to Marvin to give us a quick demo of the sign up. So you guys get a feel of what the Raise platform looks like. Given the questions you guys have been fielding, I think there's a lot of value there. I think there's a lot of products there's a lot of features we have in our product that could really help you guys with fundraising, with thinking about valuation, and so on. Marvin, over to you.
Cool. Yeah, thanks for that. We wanted to summarize this conversation, like, in addition to doing these workshops and speaking with you and understanding where people are going and what you need support with, like, understand that we build the product in such a way that it helps solve these things, especially since we also learn from using it as well. Some of the same questions you've asked all day is like, I hope you've also heard that we've also faced the similar things, fundraising or dealing with these different kinds of assets. So in the platform, we do a lot to make it easy to do these things. So today we talked about valuations and the sizing of round. There are a mix of two features essentially in the Raise platform that allow you to basically do that whole journey. So you should be able to see my screen. It's a gray screen background. And this is a demo company that is fundraising on Raise and has their cap table already loaded. So you've gone live, you went through the onboarding process, and there's a sign up process you can follow, and Samantha and the team will be happy to help. And we will follow up by email to do that. But assuming you've already gone through that process, now you're filling out a deal room. In this deal room, you can invite investors directly. So this deal room has 10, 15 different investors already invited and people to view the deal and invest in the deal. And in here, you went through the process of filling out a deal room. And in this deal room, there's different tabs, including details on the company, the terms of your round, how much you are raising, as well as a simulator. So to like next question, if you just quickly want to know, how much is $200,000 in this round based on my current valuation in the deal? And it will tell you these details that investors will also have access to. Someone just bought $200,000 worth. This is their price per share. This is how much percentage of the company you would own, even if they had a safe. So these details make it a lot easier to communicate to investors as a part of your deal. And in here, there's a tab called Financials. And in Financials, you fill in out both historical and future performance, like Neil and others were alluding to. And in here is where you can request a valuation. So assuming you fill out this financial performance, you have a sense of where you want to go. You can claim a valuation report directly within the product itself. And the team will be able to assist you or through intercom. And in here, you follow this process, fill out the form, fill out the details, the questions, both qualitative and quantitative, to help you go through the process of building out the valuation. And then from there, that is dropped back into your account. And once it's in the account, you can start running these scenarios that we've been talking about. So using that valuation that let's say the company's valuation is a 4 million now, you can start running different scenarios in here to understand what the valuation company is going to be over time, what kind of terms you want to set, what kind of instruments you want to use. We've built this to be, excuse me, I don't know how I did that just now. There we go. Use the valuation to set the terms of this round. So if your valuation was a $4 million valuation, you say, well, I want to raise my safes at a 4 million valuation cap. All you need to do is enter that. You select that you're doing a safe, it's a convertible note, and you're doing it at a 4 million cap. And then you can update this and it will show you these details over time. It will update the simulator for your investors who are able to navigate and see it. And then these details, like Nick and others were asking, you'd be able to view and communicate. And then from the investor side, this is kind of what their view looks like in the actual deal room. They'd be able to see these details. They'd be able to see the actual valuation, your financials. This valuation will automatically pop up saying that there's a 4 million valuation cap. The high bound is 5 million, which means if it was higher, and then 3.5 if it was lower. So this is the range that they start off with. and investors can download the actual valuation report directly from your account on Raise. You don't need to do anything more than that. So when you go into conversations deal and asking people to be like, yo, I want you to justify why you think that my valuation is lower than the one that I'm advocating for, tell them, look at this report, look at all this data, and then ask them to provide you with a data-driven reason for why they believe your valuation should be lower than the one that you've invested time and energy and resources to build. And you'll see that most times people don't actually have a numerical answer for that, because you do. Because you know your key driver metrics, you know your use of proceeds, how you're spending money, and you know what your burn rate is. All of us on this call, all founders are best placed at this stage, especially to drive the valuation, especially because it's like storytelling and narrative based and reinforced by data. So showing this and giving people the opportunity to see this, as well as for those investors to run simulations based on those actual terms that you've come up and deals that you've come with. Here, this is an investor simulating something. They can also start to answer their own question. If they know they invested 200K in this demo company, they get 36% of the company, et cetera, et cetera, et cetera. So ultimately, like as a way of wrapping up, when we talk about valuations led by Ozichi and then a sizing of a round led by Finn, at the very root of all of this is understanding that you sell in percentages of your company. And when you sell in percentages of your company, you have to do that very carefully. 0.3% of your company, 2% of your company, all those things are very important things because you sell pieces of your company. Like Tina says all the time when I'm out fundraising on behalf of Raise and leading that process. At this stage, since we all just trying to grab money and build the things that we need to build, we're giving out these terms left, right, and center. We're saying, here's this valuation cap, here's this valuation cap. I feel like my company is worth this. What we actually doing is either undervaluing ourselves or overvaluing ourselves. We're not actually using data to arrive at a financial metric for the company that makes it such that we can preserve percentages on the cap table for our teams and employees, as well as organize the percentage of the company in such a way that early investors can get money in the future. So the combination of these tools allow you to do that. Starts with the valuation. We can't feel that our companies are worth a certain amount anymore. We need to be able to prove that they are worth a certain amount because we work hard to do so. So this is a bit of a demo of the Raise platform. Sign up at any time on getraise.io. If you are not already signed up, many of you who spoke today are. You can just get started for free here, or just start up a talk with Samantha in the chat box, and we'll be sure you get signed up. Samantha, Ozichi, and the onboarding team are always happy to assist, and then we're always here to assist as well. And here on our website, you can find resources on these conversations we've had. So if you go to community page and check out the different posts we have on valuations, deal rooms, different things like that, these should start to help understand how to build out these things as more resources available. Thanks for that time and your questions, Rishad. I'll hand back over to you.
Thanks a lot, Marvin. Ahmed has actually just sent us a message saying that he is available. He had some network issues. So Ahmed, I'm gonna unmute you. We are short on time, so let's keep it concise. Ahmed, would you like to go ahead with the question?
Okay, hi, can everybody hear me?
Yeah, loud and clear.
All right, cool. All right, so my question is a bit more about in the area of structure, right? So I was doing some research and I realized that since most of the startups that are based in most African countries, especially those in Nigeria and those in Kenya, for example, majority of the time they raise funds from foreign investors. And most of these foreign investors tend to want to invest in companies that give them a sense of security. For example, companies that are domiciled or registered outside the borders of Africa, let's say in the UK or in the US. So I really want to understand for typically, for example, my company is registered as a Nigerian company. But I got to find out that I would have to register another company in the US, for example, which will now have a majority stake in the Nigerian company. And this will now be the basis for which the investors will actually invest in the company. So I really want to get this straight. I don't know how that structure works. If the race team can actually give do some explanations on that aspect. Thank you.
Yeah, Ahmed, we send in a link in the chat box. It's called flipping. So the process that you're talking about, having a foreign company and then Delaware and a Nigerian company and Kenyan company, I sure a lot of people on the call experience that. That's a process people call flipping, where you're basically saying investors investing in a Delaware company, and then they have the Nigerian, Kenyan, South African company as the subsidiary. So this article gives you a sense of the 3 reasons when to do that and when not to do that.
Okay.
Definitely reach out to us if you're doing it, because we have law firms and partners that we can refer you to who will help you do this properly, because you need to do it properly now because it has implications in the future. And happy to go into more details of how it works, but this article should really break it down for you visually.
All right, that's cool. Thank you. Thank you.
All right, thanks a lot,
Ahmed.
Right, and I think that that brings us to a conclusion. It's been an absolute pleasure to have everyone here. We've had some excellent questions. We've had some great answers. And I think, yeah, we've probably all learned a little bit more about the space. What we'll do next is we will, I believe we have a founder's toolkit that we would like to share with you. In order to get access to the founder's toolkit, and Sam, Ozzy, please let me know if I'm saying this wrong, but we have a feedback form we'd like to share with you. I believe if you give us your feedback, we'd love to use that contact to send you back the founder's toolkit. Sam, Ozzy, is that correct, or have I misstated that?
Rishabh, yes, that's correct, actually. We really want your feedback so we can improve on these workshops and be able to provide you with better information in the best way possible. So Sam, my colleague, has just shared the link to the feedback for everyone. So if you could just click the link and give us feedback right away, we would appreciate that. Thank you.
And if I could add,
yeah,
sorry, go ahead, Ozzy.
I'm just going to drop my email address in the chat as well. So if you would like to receive a recording of the workshop, please just respond with a yes in that email, to that email address rather. Although at the beginning of the workshop, we weren't recording, but we're just going to do our best to fix that, see if we can find a way to make that adjustment. Thank you. Marvin, you can go on now.
Of course, thank you. I just wanted to give Rush, if you'll allow me, a quick tour of what a founder's toolkit is, how to navigate. So I'll just share my screen for a second. So here, everyone can see a Google Drive.
Yep, perfectly visible.
Thank you. So we were just talking about something called a toolkit. The toolkit is a set of free resources that you can use to continue building your company. So in here, we constantly updating this and making this better and improving it. So your feedback is very helpful. But this is the version that'll be distributed after the feedback form is done. And in here, what this is we organize it by country. So let's say like the question who was just being asked by Ahmed is in Nigeria. And if you navigate in here, you can see all the documents, some documents and more documents being added if you're a Nigerian company. And same thing, if you are a Delaware company, you need to create a Delaware company, then we are constantly adding documents and improving documents here that you can use for your Delaware company. So this toolkit is meant to be a free open repository where you can download and use documents that make your life a lot easier and a lot cheaper. So this is a bit of a tour of it, and hope you enjoy using it. Thanks, Rush.
Very welcome. Great. So yeah, once again, thank you all for being here with us. If you have any further questions, feel free to email us. If you'd like to have a look at the platform, Ozzy and Sam are the right people to speak to. Ahmed, I've just seen your question. You said, where can we find the toolkit? If you look further up in the chat, Sam has dropped a link to the feedback form. So if you fill out the feedback form, we'll be happy to send you the toolkit once we have your feedback. So I believe that should answer your question. Great. Oh, I can see there's a couple. I'm going to paste that again. Because I can see a few people are still looking for it. All right, I've pasted it down. Suleiman, you should see it right now. I've sent it to everyone. So yeah, you'll be able to get access to the feedback form from that link. All right, well, with that in mind, I'm going to end the session. Thank you very much, everyone.
Thanks everyone for joining in. Thank you.
Thank you, everyone.